Hello, everybody. Thank you so much for spending the next 20 minutes with me. My name is Darren Davis, one of the principals here at Club Capital, and
Robin Massey, Senior Director of Investor Relations.
And thank you guys so much again for tuning in for this. This is our inaugural presentation under our new brand, Club Capital. We're really excited about this. We've been working on Club Capital for several months, and it's nothing new to us, what we've been doing with our investments in common equity and preferred equity, but this is something new for you guys. And so we wanted to take a little bit of time and not only go through the opportunity, but explain what is pref equity and why do people want pref equity. And in our industry, hasn't been used a lot in the last decade because money was so cheap. But today money is a little bit different. The environment's a little bit different, and what that's doing, it's creating an opportunity for us. I mean, the market's driving opportunities and we're going to take advantage of it. So on this first slide here, we pulled some headlines from some of the media, and you can see, preferred equity is pouring into multifamily. Pref equity is a rescue line. Pref equity takes center stage. So again, this isn't anything new to the industry, but it may be new to you as an investor. So let's keep going, Robin. You know what? Why don't you take this one?
Sure. So this asset that we actually have the pref on is located in Denton, Texas. For those of you not familiar with Denton, it is number 4. You can see up there, fastest growing nationwide in 2002. The population growth has increased 25% since 2010. It's just, people keep flowing into Texas. It's just ideally located to Dallas, Fort Worth. It's right in between those two off of I-35. So you can just see that, all of this is backing a really good asset. The demographics are there.
Yeah, needless to say, I mean, Texas is a growing state, population-wise, job-wise, and Denton's right in the middle of it, the North Texas area.
So as you can see here, we have major local employers within the Denton area, a lot of medical, higher education as well. Regional areas, you've got Exxon, Caterpillar, all of these industries are driving all these demographics and these people coming to this area.
Yeah, and what I think is really important to understand is, COVID created something that we've probably should have done years ago, and that was we were offshoring so many jobs to China. Well, now we're onshoring those jobs, and what's happening is all of those are coming back to South Texas and Mexico. And if you can see here, the two interstates, the one on the left and the one on the right, Interstate 35 is a major thoroughfare from Mexico to Canada. Transportation, goods, trucking, it's a massive thoroughfare. And we have an I-35 West, which actually runs through Fort Worth, coming from the south, from South Texas. And then you have 35E, which runs through the Dallas area, but they converge in Denton, and making Denton an incredibly popular employment spot and a growth spot. And as you mentioned, I think you did, if you didn't, I will. But not only do we have the industries of transportation, trucking, but we also have 2 major universities, University of North Texas and TWU. So you've got a really nice blend of employment there, from higher education to transportation to industrial type businesses.
And also medical.
That's true. You got a brand new medical hospital there. So.
Let's go into kind of the property highlights. So the legacy at Denton Crossing, obviously we kind of went over its location. It is out of Denton, Texas. It's going to be a Class A development, multifamily garden style, and it has 264 units. Major thing about this property, which we want to point out, is the property tax exemption. So do you want to kind of touch on that, Darren?
I'll kind of talk about this. In the preferred equity model for investing, you don't have to do as much of the overall underwriting. I mean, we still do, because we don't want to invest and put any type of investment in anything that we wouldn't want to be an owner of. Okay. But what's interesting about this one, and there's a couple things I really like about it, not only the location and the size and all that, but the property tax exemption. Here in the state of Texas, there's, like most places, affordable housing is an issue. Well, the state has set up some programs where if you do an affordable component to the property, where some of the units are affordable through the median family income, the state will allow you to not pay property taxes. And when you look at your biggest cost to owning an asset like this, the number two cost typically today is taxes. So if you can wipe that out and you can set that at zero, and then as medium family incomes increase and prices or rents go up, that spread between that zero, 3% 1 year, 2% 1 year, 4%, it makes the asset very healthy financially. So we like that a lot. So we won't be participating in that, but the point being, it strengthens the asset for us, ensuring the viability for our investment. We'll talk a little bit more about that later.
We kind of touched on this, but the steady workforce, we kind of alluded to, there's tech, there's, medical, the higher education with the universities that
very
are
diversified. Yeah,
very
we're not just in one industry. And I think Texas, DFW is like that. The Austin market's like that. A lot of people, I remember Houston, 20, 30 years ago, it was energy. Well, today it's not, so if the energy market went down, everything else went down. Denton's very well diversified.
And then let's speak real quickly to our partner here.
This is a repeat partner. This will be our third project with them. We have done one investment full cycle, and we did very well with our investors. We have another one that's about 2 years into a 4-year investment. The partners out of Dallas, 30 plus years experience in development. So we're very comfortable and confident in their ability to execute. Let's get into the meat of this, kind of what's in it for the investors. So I'll let you kind of talk a little bit about kind of what you were hearing from investors over the last couple of years, and one of the reasons we decided to do this.
Obviously, a lot of the feedback that we've been receiving has been immediate cash flow. Everybody wants to see those results immediately, something tangible. So that is what's great about this opportunity that we have. You're going to see cash flow starting that first quarter. Another thing in the environment that we're in right now is that higher priority in distributions. So that's giving us a little bit of security. That's placing us in the capital stack in a different position than if you were in a common equity investment. It's a great opportunity to diversify your portfolio. Diversify into, a lot of people like multifamily, so you can stay in multifamily, but you can be in a different location within that capital stack today. And of course, the major one is capital preservation. We all want to keep that capital safe, let it grow. So this kind of opportunity.
And I will talk a little bit more about preservation and diversification here when we get into the actual capital stack. Kind of explain at a very high level what preferred equity is and the role that it plays. If you can see on the left image there, you can see at the very top, it says common equity and then preferred equity and then senior debt, and then you have a total. Well, what has happened over the last 2 years is that the preferred equity is becoming a part of the capital stack because of interest rates, inflation, leverage, values, and we'll talk a little bit more about that in a second. But this preferred equity sits right behind the senior debt, and it has a priority payment over the common equity. Now, the difference here is that you're not going to make the upside that common equity would possibly have. You have a defined return and a defined timeline. And most of these timelines are in the 2 to 4 years, maybe 2 to 3 years. And the defined return is typically, double-digit annualized return. And we'll talk about the cash flow and then how this thing exits. But it's real important to understand that you sit right between the common equity and the senior debt, which is your construction loan, and you have a priority payment over the common equity.
Well, so we've been getting a lot of investor questions. We kind of rolled this opportunity out, soft launched it right before the holidays. I've been getting a lot of questions from our investors. So if you don't mind, let's hit a few of these right now.
Let's go hit the top 2 that we got.
So what is your due diligence process for considering a project for preferred equity?
That's a real good question. And I want to tell you first that we underwrite this just like we were building it or buying it, okay? Even though we're not, this asset has already been underwritten by the sponsor. It's been approved by the lender. It's been approved by the common equity. So what we're doing is we're coming in at that preferred equity after the project has already started. We underwrite the sponsor. Okay, we want to make sure they have credibility. We look at the supply and demand. We didn't just look at this asset and say, oh, we're going to do it on a piece of paper. We did a site visit. We did a sponsor evaluation. We looked at the entire pro forma. So it's one that we, quite frankly, if we own this, I would be happy. Okay, but we're not in that position. We're in the position to help these guys. Like I said, we're going to underwrite it just like we would anything else.
Next question, why does this project need preferred equity?
I'm going to spend a couple minutes on this because this is really important. I mentioned earlier that, preferred equity has not been a tool that's been used, really from, 2010 to 2022, give or take. The cost of capital was so inexpensive from the actual senior debt and common equity that it was just not something that's needed, because preferred equity has got a more expensive price tag on it. Yeah. And what has happened here, and I'll kind of explain this, fairly quickly, but as interest rates went up, that cost of capital became more expensive. Well, what happened is that people had not adjusted or expected or put a reserve in for interest capital. So when they took these loans out 2, 3 years ago, 4 years ago, interest rates were floating and they would get 3.5%, 4%. Well, over the course of the last 2 years, we've seen that 3.5%, 4% go to 8, 8.5. So that gap is something that sponsor was not prepared for. So they're sitting here going, all right, I need to fill that gap. I need to complete the project, either finish the construction, finish the stabilization, and get it ready for sale. And what I'm doing here is I'm preserving my capital and my asset, knowing that things are going to get better. And as we speak today, this is January 2024. We're already believing that interest rates will start to come down. And we are seeing prices of construction start to come down, and we're starting to see things stabilize a little bit more. But there's a couple of things that are also happening here. Not only have interest rates gone up, but once that happens, that impacts the leverage. So lenders, 3, 4, 5 years ago, were lending 70, 75, 80% of the cost to do that project. Well, now, if you go back to do a refinance because your construction loan is now due and you need to refinance that, the leverage has gone from 75% down to 60. So that gap has to get filled, right? And then just to throw a bunch of salt on the wound, then you have what's happening with the appraisals and the valuation. So what's happened here is an asset that may have been worth $80 million on paper 3 or 4 years ago, that valuation, because interest rates went up, leverage went down, the valuation came down. Now that asset may be worth 60 million. And then if it's worth 60, they're only going to loan you 60% on that 60 and not 60 on that 80. So it's been a perfect storm for sponsors. And, if they can just ride out the next 2 to 3 years and preferred equity being a solution, they're going to be fine. And in the event they can't get through it, they have a couple of options. One, they can return the asset back to the lender, which nobody wants to do, or they can seek out, private equity groups like us for preferred equity, and then we will be in a position to help them. So, I'm gonna talk a little bit about the cost, but that's kind of what would happen. But that's why they need private equity. We're here to help them. We're not here to, try to take their asset, but we also underwrite it in the event something does happen. We wouldn't mind owning that asset at a discount. Yes. So, okay. The other question we got here, which you got quite a bit of this, is go ahead.
What is the loan to cost or LTC ratio?
Yeah, and this starts talking about the valuation and how it impacts us directly. So if you look here, this is roughly the numbers of the project here up in Denton. Total cost is 65 million-ish, give or take. All right. The senior debt is around 45 million. And you can see that the common equity that came in originally just a little over 16 million. Well, our piece is going to be 4.3 million. So if you look at the senior debt and us, we are representing 75% of the capital contributed to the project. And the common equity would be that 25%. Now, what's important here is that we like numbers that are 70, 75, maybe even up to 80. We probably wouldn't go up to 90, 95%, because then you see the pref equity taking a much bigger position and the common equity coming way down. And that common equity is really our safety net. Yeah, so this is fairly straightforward. This is pretty consistent. 75% on the senior debt and preferred equity, and 25% on the common. So that's the cost. So
you said that security net. Can you elaborate a little bit more? I think this next slide really kind of hits.
Yeah, I mean, this is just to break it down into numbers. So if you look at the capital stack, including the entire amount, common, preferred, and senior, that's 65 million, and that represents about $250,000 a door on cost. Okay. If the common equity was to go away, it happened, we're not expecting it to, our cost would be about $187,000 a door. So you can see the disparity in the numbers between 187 and 250. That's our safety net. So if we end up owning this, we would end up owning it for $187,000 a door, and not the 250. So that's like I said in the beginning, I wouldn't mind owning this asset, but that's not the goal here. So.
Well, a big one all of the investors want to know, obviously, is how will this reflect on my K1? So can you touch on that?
I'll tell you, obviously we're not tax professionals, we're not legal professionals, and we're not going to give you advice on that. But this is typically treated different than a common equity investment. And it really comes down to income and capital gains. So talk with your CPA, but I think 99% of us would be told by our CPA that this preferred equity investment for you would be treated as income. So you would want to be aware of that if it was impactful enough. And if that's a question that's important to you, please ask your CPA. And we, in our operating agreement, we'll be able to outline the structure of the actual investment and how it is treated tax-wise.
Yes. And also I just want to note that there is not ownership within the preferred equity position. So you will not see any depreciation.
Yeah, that's another question. I know I got that a couple of times. Hey, will we get any depreciation? It's just a depreciation asset. We don't own it, and we're not part of the general partner group. So we would not receive any depreciation benefits. Yeah. Project investor returns. This is where we talk about the meat of the deal, right? Okay. So I want to point out something as we talk about this, but this is a fixed rate of return, 12.5% annualized. And if you see the structure there, you make the investment, and then year one, you'd receive $7,500 paid out quarterly. Year two, you would receive $7,500 paid out quarterly. Year three, what you see is the remaining interest plus the accrued interest for the $22,500. But here's what I want to point out. If you look at the top of this slide, you see 7.5% current pay and 5% deferred. So what we've negotiated with the sponsor is that they would prepay 2 years of interest of 7.5%, so that we could turn around and make those payments to the investors, right? 5% of that is being deferred through the project until we exit. Now you may be saying, what initiates an exit? Really, there's two things. There's a capital event, one, which could happen before the loan matures, or two, we are coterminous with the senior debt, so the bank loan, the construction loan. So there will not be a reason that we go past a capital event, and that capital event is expected to happen sometimes towards the end of year three. We don't know if it'll be a sell or a loan maturity, but it'll be one of those two. I think the really important things to understand here is that we are escrowing 2 years upfront from the sponsor. And that we do have a minimum payment to us of 2 years, which in the event they got an offer on it and sold it in a year and a half, we're not cramming down our return to a year and a half. We're getting a minimum of 2 years.
Yes.
Over the past almost 10 years now, this has been our combined returns for our multifamily projects. You can see our average hold's been a little over 4 years. The multiple to the investors, 2.6, so 100 in, 260 out would be the average return. I will say this, those are pretty good numbers in a market that was really strong. I think expectations should be set differently today if we were doing common equity and doing the same type of thing. We did hear from our investors loud and clear, cash flow, safety, security, capital preservation. And we spent the last 6, 7, 8 months working on that. And we now are building a pipeline of these investments. So Robin, since you're working with the investors all day, every day, tell us kind of what the process is for, I think most of our existing investors know this, but anybody that's new to Club Capital, share with them what that process is.
So we have a QR code up here just above my name. If you will scan that, takes you to the full offering memorandum. So go ahead and look through that document, review it. If you are interested in reserving a position, it has a commitment form there as well. You can quickly fill out and register you into our investor portal. It's quick and easy. That way you can review all the subscription documents, e-signatures, so simple. This is open to accredited investors, and we have a minimum of $50,000.
So, I want to point something out that I think is just real important about what we're doing and what we're putting out to the market, to the investor community. There are a lot of groups that don't have the capacity or knowledge to do what we're doing. And I think for the sheer fact that the relationships that we have and the organization that we have internally, being able to take on this process and offer this and have a pipeline of these coming forward. So you're going to see several of these from us over the year, but even myself, and I've talked to a lot of friends of mine that we're all in the investing world, but being able to capture 12.5% backed by a Class A asset in Texas, especially in a DFW or an Austin, market like we live in, work and play in, is pretty strong. You're getting 12.5% in a market like this is hard. And we've been able to do that, and I'm very proud of what we're doing. I'm excited. And again, this is our inaugural investment under our new brand at Club Capital. And we have a lot of good things happening. In fact, not only have another one of these coming probably in the March timeframe, but we have some additional information or announcements that we're going to do at the beginning of Q2 that I'm super excited about.
Well, I think that's it. And we're wrapping up this presentation. We thank you all for taking your time to view this. As always, reach out to us. The info at clubcap.co will go directly to me if you have any questions specifically about the subscription process. Reach out to us. We appreciate your time today. Darren, you have anything?
Yeah, thank you very much. No, look forward to talking to you. Please call either one of us anytime. You all have my cell number. And if you don't, it's on the website. Thanks, guys. Bye.
Thank you.